What's up, guys? Today we're going to be looking at Greenbrier Companies stock. The stock is trading up 13.06% after hours and had a very strong earnings report for Q3 2025. We'll take a look at that as well as the overall valuation of this company. But some quick highlights: they had strong Q3 earnings and $843 million in revenue. They had 5,600 rail cars delivered in Q3, fueled $60 million net income and 75% EPS growth. $2.5 billion backlog and 98.2% fleet utilization signal rail sector resilience. Margins up, cash flow nears $140 million as operational efficiencies pay off. Dividend declared, buybacks continue, and new credit facility extends to 2030. So some more highlights from this Q3 2025 earnings. Net earnings attributable to Greenbrier of $60 million or $1.86 per diluted share on revenue of $843 million. Aggregate gross margin of 18%, which was the seventh consecutive quarter meeting or exceeding mid-teens gross margin goal. Operating margin of $93 million or 11% of revenue. EBITDA of $129 million or 15% of revenue. New rail car orders for 3,900 units valued at more than $500 million and deliveries of 5,600 units, resulting in a new rail car backlog of 18,900 units with an estimate value of $2.5 billion. Repurchased 507,000 shares for nearly $22 million in the quarter, $78 million in remaining under current share repurchase program. And we got a statement here that says for the third quarter, Greenbrier achieved strong financial performance with net earnings rising both sequentially and year over year. Our aggregate gross margin percent continues to surpass our mid-teens long-term target. These results reflect our continued progress on operational initiatives across the company, including footprint optimization in Europe, insourcing expansion in Mexico, and disciplined execution in our leasing and fleet management segment, which is steadily building recurring revenue. And we can see we got updated fiscal year 2025 guidance. They increased their expectations for aggregate gross margin percentage and operating margin percentage as well. So that is a very good sign for this company. They are growing in overall profitability, which is very impressive. If we take a look quarter over quarter with this revenue, they had $762 million in revenue for Q2. They grew that to $842.7 million in Q3. Keep in mind, they also have a massive backlog to fulfill too. So that is very attractive. Their effective tax rate, it says here, quarter over quarter reduced from 32.3% down to 22.8%. And their note here says geographic mix of earnings and favorable net discrete items, primarily related to foreign currency fluctuations. So that's a pretty cool sign there. They reduced their effective tax rate. Core diluted earnings per share quarter over quarter grew from $1.69 to $1.86. And their note here says higher revenue and profitability as described above. So that's very attractive from this company as well. And one thing to look at as well is their cash on hand also increased from $263.5 million to $296.8 million in cash on hand. So really attractive stuff coming from this company. Very strong growth in their overall profitability as well as their earnings per share. But what I think may be more attractive than anything is the PE. It's only 7.35 prior to this earnings report at market close today, and their forward PE was at 8.86. This company also has a dividend yield of 2.72%. So it's pretty attractive company with some really good numbers going on with it as well. You can see here the price to sales ratio is 0.41. So it's a very cheap stock. Now the question is, can they continue that growth in the future? With Seeking Alpha analysts, you're getting a buy rating 3.5 out of 5. Wall Street buy rating 3.5 out of 5. You're looking at valuation rating of A minus, growth of B plus, but profitability of D plus. I wonder if that's still accurate though, considering how good this earnings report was for this company. If I missed something about the stock, please let me know down in the comments. And if you got value from the video, please consider subscribing. Y'all have a good one.